and hit this case study I want to show you here today to, again, illustrate that regardless of your experience, if you have a goal in mind, if you set the parameters and the ratios for looking of all the inventory that we have, if you properly set the ratios, which look at your risk, they look at your discount, and they look at your return, if you take that point of view and you have all of this inventory, you can start to narrow it down to a scope. And that's why I have been able to very successfully work with people one-on-one and get them into a deal in a very quick period of time. Now, you don't have to get into this industry and say, I got to be in something quick. I'm not saying that. But if you are and you say, how quick can I get in a deal? I'm ready to go. I'm willing to do what it takes. I'm willing to listen, and I'm willing to be coached by you properly. What can I start to anticipate of what's happening? So this is a good case study, and we'll do a lot more of these as we go through, because I've got just plenty of them. This one, I got them in their first deal within 30 days. Okay. Background is they knew about the industry. They've looked at a couple of things on the industry. They've been to a couple of free preview type of training events, but just weren't getting any kind of results, because again, there's a difference between education and then converting that into action. And there's a little speed bump in between there, which people have to navigate through. And if you're doing it on your own, that speed bump looks like a wall, where you're just bouncing off of that thing, because that's when all the fear starts to come in. You don't feel like you quite know enough to take that risk. All of those case studies that look so good, all of the stories that look so good about, yeah, we did this, we did this, we did that. All of a sudden you're going through that and running into this wall, when reality, it's just a speed bump if you have somebody to guide you through to the other side of that. And I think that's a big deal for people getting started. So this person came in, had some knowledge, some background, some free trainings, live and online, that they were looking at, but really just felt, okay, I've got to do something to get this to the next level. So the initial call that I had with this person, I say call it a Zoom, is to find out, again, what are their goals, what are their needs, what are their expectations, are those expectations real, what's their fear level, what's their risk tolerance level, and all of those things. You start to boil it all down, where you can say, okay, this is, at least for the first couple of notes, this is the right type of note for you to buy, and here are the three parameters that you're looking at. So this was the actual transaction right here. I took a screenshot of it early on, and this was a performing note. And for beginning investors, that's usually the logical place to start, where you're not shaking on so much, where you're buying a note that has a lot of problems with it and you're brand new. It kind of makes sense to go through, at least on your first one, a deal that you can just see how all the parts start to come together to get to a closing. And Dwayne, you and I have said this all the time, where as good as I can train people, part of the education is by completing a transaction. I mean, you have to go through that experience, because more questions come up as you start to go through it, and they're all
Yeah,
a little bit different, right?
Absolutely.
Yeah. So this one, you can probably read the text there, but being we're Facebook Live, maybe you can't see that. But the investor who owned this note owned it for over 3.5 years, and never had to talk to the borrowers, meaning it's a very passive note. The borrowers simply pay every single month, probably by auto debit. Never had to pay for their insurance or taxes, meaning it's being escrowed. Nope, sorry, it's not being escrowed, but the people are paying their taxes and insurance as they should every single year. It's something that you verify. Their payments have always been on time, and they are making extra principal payments all along. If they continue to make the extra principal and interest on the loan, it'll be paid off in August 2032. If they make their required minimum, it goes out to 2033 in February. It's being professionally serviced by a company that we're very familiar with. I know the owners and son, and Servicing fees, $15 a month. Selling the note to pay taxes on my Roth conversion. So this investor is telling us that I'm selling this note, not because I'm having a problem with it. He's very clear about that. He's going, I need to sell it because I'm raising capital to pay taxes when I convert my Roth IRA over from a traditional Roth to a Roth IRA. And you have to pay taxes on that money now. So that's what he's looking to do. And all that makes sense to me as well. So we can see it's a contract for deed. The original loan was $51,000. They owe $33,850 now, and they're asking $31,250. And let's see, I got property value probably on I got it on another slide there. So we'll look at that number as well. And whoops, went backwards there. Not being escrowed, payments are $451. There's 117 payments remaining, and the original loan was written at 10% interest. We call that the coupon rate. That's what the borrower is paying. That's not going to be the same as our rate of return here. So they're asking for $31,250, which is a discount from the $33,000 here. And let's run some of the numbers. So one of the things we have to look at that I told you about is risk. And risk is the difference between what you're investing and what the collateral is worth. The lower that ratio number is, the safer the investment is, because your collateral is just worth that much more money. Now, in this case, you can see just utilizing one source, but we don't use one source, by the way. We end up doing multiple sources to come up with value, but I don't have enough screen room to put all the different sources that we used on this. But the property is worth over $200,000 very easily by a number of sources. I just happen to pick Zillow to show that to you. So don't let your Zillow bias, if you have one of those, come in and go, well, Zillow's not real numbers. It's not the only one I look at. It's not the only one I look at. It was the most convenient one for me to take a screenshot of. But anyway, that's what it is. 237 is what Zillow says, but it's easily worth 200,000. Now remember, our investment in this thing's going to be $31,000. So you're in it for 14, you're in it. I'll have to give you the right number. I've got it on here somewhere. But think about your risk. Even if property values go down and this plummets all the way down to $150,000, you're still only in it for 30 grand. And if the $200,000 property goes down to 150, there's a whole lot of other stuff going on in the world, right? Which could happen. It happened in the last recession, but let's face it, you're safe. Because if things go to hell in a handbasket, your investment, if it goes into default, is backed by something worth about $200,000. Very, very safe. We can check that box of safety for sure on this. Okay, so safety is always number one. Don't make yield number one. Drives me insane. I'll mention more about that later. It's risk first. Identify what your risk is. And by the way, by extension, things you wouldn't probably know, Georgia is a good state for notes. It's a very short foreclosure state. It takes typically 90 days on a foreclosure. So if something were to go drastically wrong, it's a very short process because it's non-judicial, especially with this type of instrument. But it's very likely you're never, ever, ever going to have a problem with that because of the payment history, but also because of the equity. Think about it. If these folks struggled financially, if somebody got hurt on the job and they've lost an income, they've got divorced, whatever a situation might be, and they can no longer afford to make those $451 a month payments.
Wow.
Which again, rent's probably in that area, $1,500 a month. What did Zillow say? Yeah, $1,400.
Yeah.
No, $1,700 a month. They're paying $450. So they're motivated to stay and pay because it's a heck of a lot cheaper. They've got $200-something thousand in equity based on what they owe. If things went horribly wrong, they would sell that house for $190,000, walk away with, pay you off the $35,000, whatever was owed on that loan, and they'll walk away with a bunch of money. Okay, so your risk is just from every angle very, very low. Okay, so then after we started running through these ratios, we looked at the risk, we looked at the discount, we look at the potential yield on that. When we start to do that and it fits within what somebody's looking for, the next phase is, well, let's take it to that next level of due diligence, right? So I teach in layers of due diligence, and that technique has worked so great. That's copied all the time now. That's how people do the business for the most part, because it's the one that works. And I've been doing that for a long, long time. If it passes this, then I'll go to the next level. If it doesn't, move it on. Just move it on. So this one, I was able to see the current seller who has the note. I was able to see that all the property taxes were paid in minutes, just on public records. I could see the sales history of the property, the type of instruments that were used in that entire sale. I could see where the whole deal came from here, the most recent transactions, historical transactions. I can see everything that I need to see and check the boxes. So I start to understand the story. And Dwayne, you've heard me say this a million times, but to master this, it's numbers and story, because they both have to make sense for you to come to a logical conclusion. We got a payoff on the loan, so we can see exactly where this loan is, what the balance is, if they've ever had late or unpaid interest fees, all of those sorts of things that will show up on this form. So we can see the bottom line. This person told us that these people are paying on time. Now we're verifying it. It's all in the paperwork. They are paying on time. They've been really good on this loan. Everything is starting to match up. Then we start to look at the payment history. Now, this payment history, you won't see this too often, because it's got negative signs there. Okay, usually those are not negative signs, they're positive numerals. These are negative, meaning they're paying early. So he's right. Not only are they paying on time, they're actually paying early, and in a lot of cases, they're paying extra principal. Okay, so they're doing really, really well on this loan. We looked at all the paperwork, everything that comes with it, all of the original notes, the original assignments, the allonges, all these sorts of things that we just connected. We say, yep, it went from here to here to here, and now we're buying it from them. Perfect. Everything was there. As you can see, everything was recorded properly. So this we call, was it papered up the right way? Right. So we check the papering of the instrument here. And unlike an origination of a loan, we go back and just look at, did they do it the right way? Was it transferred the right way? Very simple process. Now, we also will normally take an extra step before we close on this, that we'll order a BPO, which is broker's price opinion, and a title report. Okay, so we'll start with the broker's price opinion first. When we first looked at this, I told you that there was a value on Zillow of $279. Was it $279? Is that right?
Yeah.
I think it was. Let's see.
237.
My apologies. Yeah. 237. So good, but how about before we close on this deal? Okay, we've seen all the paperwork. We believe everything is there in order, but let's just get boots on the ground. You know, we don't live in Georgia. We don't live in this town. You know, I'm in Florida. This buyer, oh, I could be wrong, but I think he's in California. So about as far away from Georgia as you can possibly get. And, you know, he hasn't seen it other than some pictures that you can see online. But we can have boots on the ground. So with one phone call, we order a BPO and a title report. The BPO from a local person who took pictures of the property. I'm not showing the whole report here. I'm just showing the bottom line. And that came in at $235. Quick sale at $215. So Zillow was pretty accurate on this particular one. This had nothing to do with Zillow. This was a local agent looking on multiple listing service, the MLS, going out, taking pictures of the properties, observing the condition of the property from the sidewalk, and they came to a very similar value, as did some of the other sites like Redfin and all those sorts of things. So we felt very comfortable with the value because now we have multiple sources, including somebody locally there who's a real estate agent giving us that value.
Kevin, if I can add, I mean, we have seen different ends of the spectrum of the BPO coming back way less, where Zillow or Redfin, they're saying, hey, it's worth 237, but the BPO comes back at 72, 84, right. Big difference. And so, I mean, this is a clean deal right here.
Yeah, exactly. And to your point on that, I always go with the local person. You know, if
Absolutely.
Zillow and the others say one thing, they're basing it upon algorithms
Comps.
of that
Yeah.
whole area. And sometimes you
Yeah.
have these areas that, you know, you got some homes built in 1910 and then you got some homes built in 2023, you know,
Right.
so it makes it really difficult sometimes with those algorithms. But this was in one of those neighborhoods where all the homes are fairly similar as far as when they were built and everything else. So it just made for a nice BPO. So 235, so our value checks out. We're great. And the title report came back. And there were no surprises on the title report, which is the case about 99% of the time when you approach this business the way I do. Because what does a title report do? They go back and look at public records to see, are all the documents done? Or are they all recorded? Did they go from this company to this company smoothly or not? I've already done that. So I'm usually never surprised by a title company, but newer investors and your default position really in this industry should be, I'm going to get a title report anyway, just to double check, to make sure I didn't miss anything, because some counties are more challenging to find all the paperwork than others.
And there's nothing wrong with that.
No, and you know, what's the cost of this? Most people, when they think of a closing in real estate, they kind of transfer that over to real estate notes, and they're really not similar at all. When you go to a regular real estate closing, you've got all these lists of expenses, and you're bringing money. I mean, title company cost and proration of taxes and insurance, and you got all these other things that start to add up. In a note closing, normally there's two documents that need to be signed. In this case, because it's a contract for deed, there were three documents that need to be signed. All of them are signed by the seller. That is it. Three documents: the assignment of the note, the allonge of the note, the assignment of beneficial interest, and the contract for deed and the quitclaim deed. That is it. Three documents that are signed. So a closing might cost you, if you're using a facilitation service, $250, maybe as high as 500 if you're using escrow or something along those lines. So your whole closing on a real estate note is either free, if you're doing it between the two parties, maybe $250, maybe 500. Okay, so very, very small.
$250 is called a peaceful night's sleep.
Yeah, and you know what? It also, when it costs you less than $200 to order a BPO and a title report,
Mm.
you know, okay, so what's a note really cost you? The cost of getting a BPO and a title report, which are optional, but again, for less than $200, probably a smart thing to do. And then you're paying maybe another $200 to get it closed. So your closing costs are very, very minimal on these transactions. So yes, it makes sense in virtually every case to get these two items, just so you know, like, boom, I did my research right, that checked out. I thought the value was there. Now it's verified by this other party. All my other numbers make sense. The story makes sense on this deal. Boom, we're done. So numbers overall: $31,000 purchase, so we got a little less than what they were asking, backed by a $230,000 property. That puts us at a 13% investment to value ratio. That's ridiculous. I mean, you're into the value of, this is what this means, you're into the value of that property by only 13%. So you've got all of that other stuff all on the upside. And I don't like to use extremes like never or can't or you know, but how can you possibly lose money on this? You
It's
know,
possible.
it's, huh? I mean, I hate to use absolutes, but when you're backed by
Yeah.
something worth that much and it's insured and the track record, I mean, the odds are extremely slim that you could lose money on this. All right, on the other side, what are you receiving in exchange for the $31,000? You're receiving 118 monthly payments of $451 per month. Passive income collected by the servicing company. They take out a fee and they send you the balance. That puts you at a 12% return annualized, or what we call yield in the industry. 12%, very low risk. You're getting a good discount on the notes. Again, it's just one of those transactions where it's all signs just as we went through and kind of peeled the onion. First level due diligence, numbers make sense. Let's go to second level. Second level, all the documents make sense. Third level, let's have a third party look at the value, a third party run a title report. They come back and also confirm what we expected, which was values there, title is there. So not only did you look at it, now you had a third party look at it. You have the deal locked up before you even ordered the BPO and title. And then it's just a matter of boom, funding it, getting it closed. The servicing company switches over those payments to come to you. And now you're making a passive monthly income secured at 12%. And, Dwayne, we started doing these Wednesdays, and you guys can go back and listen, but we started doing a little series on notes versus. We talked about notes versus rental property, notes versus wholesaling, notes versus retailing property, notes versus stock market. And yeah, can you make higher than 12% in the stock market? Sure. Can you also lose all of your money? Sure. In this, you're making a solid 12% backed by something that's worth 200. Can the value of that $200,000 property go up? Yes. Can it go down? Sure. How far down can this go before you're in trouble? Substantially.
Yeah.
Right? So if we have a 20% drop, we got no problem. 30% drop, you got no problem. So that's what we're looking at. And that's what the attractiveness of this business is. Even if you are, you like the stock market, you like more traditional real estate where you're a landlord, fantastic. I mean, but you might want to think of diversifying. You may want to think of diversification.
Absolutely. And yourself, when we have our weekly calls, bi-weekly calls with students, there are a lot of students that are in this business that they're not stopping their day job. They're not stopping what they currently do for other investments. They're adding this as a bolt-on and realizing at the end of the day, this is a safer way for me to invest. Just like case in point, the deal that you just showed. I mean, it really, really, really have to go south for them to lose out. Unlike the question that I would have is, can you afford to take a 20 or 30% hit in your investing in the stock market? How will that affect you? Well, if you had a 20% decrease on this investment, excuse me, how much would it hurt you? Not much.
Yeah. So all of that took place within 30 days, everybody. So somebody going, okay, Kevin, I'm committing to doing this. I'm bringing you on. And think about it this way. If you're going into any business, there's a startup cost to that business. If you're buying a franchise, for example, McDonald's, you're probably looking at almost $1 million. So franchise is expensive. What are you buying? You're buying a system. Every business has a startup cost. So could you start the note business on your own with virtually no cost? You could. The downside of that is you get stuck with analysis paralysis and you don't know how to go through these things and you're trying to learn. And then again, that speed bump turns into a wall. And then you're just going like this and never getting the results that you're looking for. Why not start your business with a low startup cost where you're bringing on an expert, somebody who's written books in the industry,
I would say that if you don't have any skin in the game, that's really what you're not gonna, what do you really, if you don't put any money into it, then you have nothing to lose. When people say, oh, well, I can get into it with no money. Well, what do you really, I don't know. I agree with you.
When you look at it from that point of view, if you could start a business, for less than $4,000 and have an industry expert basically be there to walk you the whole way through, would that make sense? That's kind of what I'm kind of saying, and so glad you listened, and info@kevinshortell.com. If you have comments, questions, you want to talk to us, we'll set up a Calendly link for you to have a conversation with you. But we're going to continue to bring these to you every Wednesday right around 9 o'clock. We're going to try to hit 9 o'clock, but sometimes it might be a little late. But plan on being on these about 9 o'clock, and I'll pick some other case studies and just more things to show you and motivate you to take a look at this industry and take a look at us and see how we can help you. Dwayne,
Sounds
any
good.
final comments?
No. I know yesterday we talked about we're going to have a live event coming up. So just throwing that out there.
Yeah, look for that.
Hopefully we'll be able to give more details on that shortly.
Sounds good. All right, everybody. Until next time, we'll see you soon.
See you.